US stocks soften and gold rises as fears grow about a US government shutdown. The Reserve Bank of Australia holds rates and there's renewed doubt about a cut in November. So the Aussie dollar rose. That's coming up in our 5 Things in 5 Minutes on Wednesday, October the 1st. And then in our deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner says there's a hint of spring in the latest ANZ Business Outlook for September.
There is a certain faith that the easing monetary conditions that we've seen, the Reserve Bank's pivot to backstopping growth rather than being worried about inflation, that will pay dividends in the future.
But first, in 5 and 5 with ANZ, global markets wobbled overnight with growing fears of a US government shutdown. Stocks edged lower, as did US government bond yields and the US dollar. But gold's safe haven status right now saw it rise yet again by 0.5% to $3,873 an ounce. It actually hit a new record high overnight of $3,899.15. Meanwhile, the Reserve Bank of Australia yesterday held rates at 3.6%. That was as expected. And Governor Michelle Bullock declined to give any guidance. Here's ANZ's Head of Australian Economics, Adam Boyton, to explain.
The statement we got yesterday from the Reserve Bank does take a step in a more hawkish direction. Again, that's to be expected, but it certainly means that there is a reasonable risk that the bank doesn't ease in November, which was always the case after that higher than expected August CPI indicator that's made the Reserve Bank, I think, very cautious about providing any guidance at all, really, on the near-term conduct for policy. Our own view remains that we will get one more rate cut in this cycle.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 and the Nasdaq were down 0.2%. The US 10-year Treasury yield fell 1.4 basis points to 4.127%. West Texas oil futures fell another 1.1% to $62.72 US a barrel. The US dollar index fell 0.2% with those lower US interest rates. That saw the Aussie dollar rise, but by much more, by 0.6% to 66.20 US cents. And the Kiwi rose 0.4% to 58.01 US cents. The Aussie dollar also rose against the Kiwi, up 0.2% to $1.14 against the Kiwi. Now that's near a one-year high and is edging closer to the 115 mark we haven't seen since 2013. And that's all about diverging views about interest rates on either side of the Tasman. Number 2, Adam says he still sees the one more cut in the Reserve Bank of Australia's cash rate to 3.35% happening in November. But the chances are growing it may not happen until 2026.
Ahead of this crucial Q3 CPI that we get toward the end of this month, and importantly also the next set of labour market data and household spending data, we're going to keep a November rate cut in our forecast, although there is some risk we may need to move that into next year. I do think if the Reserve Bank doesn't ease this year, there is a possibility that we could get a little bit of a re-softening in private demand.
Number 3, ANZ's Roy Morgan Australian Consumer Confidence Survey showed an improvement last week after 2 weeks of declines. ANZ economist Sophia Angala reports a lift across all sub-indices.
The headline confidence measure is now just sitting below its 2025 average. Notably, weekly inflation expectations rose 0.1 percentage points last week, and that follows the monthly CPI data that was released during the survey period. The August monthly CPI indicator showed that headline inflation was at 3% year-on-year in August, and that's the top of the RBA's 2 to 3% target band for inflation.
Number 4, also out in Australia yesterday, was private sector credit data. Adam says the 0.6% rise in the month was in line with expectations, but he sees 2 trends emerging beneath the surface.
The first is, and it's early days yet, but it does look like there might be a little bit of a handover from prior strength in business credit, which is still running at a pretty strong clip, to a bit of a lift in credit being extended for housing. Now, you would expect in an interest rate easing environment, we have had 3 rate cuts this year, that credit being extended for housing would be picking up in trend terms. What that's telling us is that monetary policy, particularly for the household sector, is doing the sort of job you would expect it to.
Number 5. In New Zealand, the ANZ Business Outlook was unchanged in September, with some hints of spring showing through, says ANZ New Zealand Chief Economist Sharon Zollner. However, Sharon says there was a shift in sentiment after the second quarter GDP data, which came out showing a surprise 0.9% contraction.
Just like we saw in the consumer confidence survey last week, it does appear that there was an impact. Basically, every indicator in the survey was weaker in the second half of the month after that data came out. So hopefully it'll be a relatively short-lived impact. Hopefully people have short memories and we'll move on quickly.
Sharon Zollner there, who we stay with for our deep dive interview as she delves into how New Zealand businesses are faring after that large GDP contraction in the June quarter.
Well, it was unchanged in the month, but at plus 50%, that's pretty high. So that's a net 50% of firms saying they expect business conditions to be better a year from now than they are currently. Now, admittedly, that very high number probably has more to do with how weak things are now rather than firms expecting things to really roar away. But it does suggest that there is a certain faith that the easing monetary conditions that we've seen, the Reserve Bank's pivot to backstopping growth rather than being worried about inflation, that will pay dividends in the future. And that's important for things like investing and employing. That's not the best GDP indicator in the survey, though. That indicator is actually when you ask firms about how the last month has gone past own activity, and that was up 4 points. It's only plus 5, though, so nothing like as high as business confidence, but at least it's in the black. Past employment also up 1 point to minus 11. Expected own activity up 4 points as well. So overall, we could characterise the month as cautiously optimistic. However, it did become less optimistic as the month went on. We can split the sample into before and after the very weak GDP data was released, but the confidence impact can perhaps be offset by the Reserve Bank, who of course are meeting next week.
And what are firms saying are holding them back at the moment?
Every 3 months, we ask firms what their biggest problems are, and the disinflationary problems of low turnover and competition are still dominating. So that really does reflect that the economy is quite soft and that the Reserve Bank is right that they don't need to worry about inflation pressures reigniting at the moment. However, we did see a lift in the proportion of firms who are ranking non-wage costs high up in their top 3 problems. It's still behind those other 2, but it's fair to say there is still a rump of cost pressure that hasn't gone away. The construction sector would appear to be in the biggest hole in terms of the proportion of firms who are ranking competition and low turnover as their biggest problems, much bigger for that sector than for any other. Though manufacturing and retail, it's fair to say those 2 problems dominate enormously there, whereas agriculture, more worried about costs, for example.
What are firms reporting about their past activity?
So past activity is in the black, but there's a very, very wide spread by sector. And that's quite a contrast with 2 or 3 years ago where everyone was in a pretty quite tight band. Agriculture is absolutely storming ahead, storming the field. And at the other end of the scale, we have the construction sector. We have still got more than a net 30% of firms saying they are less busy than they were a year earlier. So retail, a few signs of life there, encouragingly. It's still in the red, but it has bounced back quite a bit in the last few months. And we are starting to hear anecdotes, actually, of high-end retail in particular picking up. So cars and boats and the higher end of the housing market. So, of course, the cost of living doesn't hit everyone equally. It's a big constraint on the spending of low-income households, but it does seem that some high-income households are now having the confidence to start spending again. Hopefully that's a bellwether of better times to come more broadly.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, October the 1st, the start of the September quarter. Catch you tomorrow with the latest Reserve Bank of India rates decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.